All right, Dave, look at that. We're here once again.
Oh, we are. What a crazy morning we've had so far.
Yeah, right from a webinar right to a live show. How incredible can that be?
Yeah, and mine even got worse because I went right from a test to a webinar to a live show, and I didn't think my test was going to get done in time. I was having some issues with the test that taking me longer than I expected it to. So yeah, we've had a whirlwind, but super glad to be here with you and those that are joining us today.
Dave, after this, you also have a YouTube recording as well, and then you go on to meetings. So it sounds like we're just going to make your Wednesday just magical.
Yeah, it is. My wife was asking me if I had time this afternoon to do something with her and the family, and I'm like, maybe tomorrow, but we've got a 4-hour tomorrow, so maybe it's Friday that I'm going to have to look at.
Yeah, there you go. Well, I'd like to welcome all of you with us today. Once again, we're always here talking retirement. I think that's the one thing is we want to make sure that you understand why we're here, what we do, what we focus on. One of the things we really want to focus on, Dave, is making sure that we're educating all of those CPAs that are with us, because that is such a key, important part of what we do.
Absolutely. It's definitely everything almost at what we do at this point is making sure CPAs get educated, but we're happy to welcome anyone that's not. It's part of our job is to get everyone to a safe and secure retirement, and we do that through education.
And Dave, just to start out again, letting people know we come on and we ask questions that have been given to us. And we also try to give as much background as we have on this. So I'm going to launch our first question here. And this one is, Wade has a client that has been working as a teacher for 20 years. What should Wade recommend his client to do towards bettering their retirement?
One of the things that I would definitely recommend here is they've got to really look at where Social Security is, because a lot of times as a teacher, they've been in some type of government retirement program, but not always. Depending on where they're at, they may or may not. So they've got to figure out what are the benefits that are all available. What's there for Social Security? Is there a pension plan of some type, and what's available there, and how much is it going to be? Because once they figure out what the base looks like, hey, then we can start putting things in place to solve the rest of the equation. But until we figure that out, really hard to give them advice, because again, if there's no Social Security, it's going to look substantially different than if there is in a pension. If there's no pension and just Social Security, well, that's going to look a lot different.
Dave, you're a CPA as well. So imagine if somebody sits down in front of you and just says, Dave, I need help. I mean, I look at this question, I feel it's very open-ended, but I think it's one of the things people are just trying to sit down and say, how do I even start?
Yeah, a lot of it comes down to asking questions. People always found that odd about myself. Even back in the days when I used to do tax work, people would come in and I'd spend the first probably half hour just asking questions and trying to learn more about them, where they're at, what they're trying to accomplish, what they had available. But that's really where it comes to. It's like, hey, let's get to understand who they are. Let's find out who they are as a person, especially when we're talking about retirement. Everyone has different approaches to it. Talk to people that are, hey, they think the market's going to go up forever. They're not concerned at all about where they are. Got others that pulled 100% of their stuff out of the market, have it in a bank account right now, and are saying, hey, I'm just waiting for the crash. Well, those are two different planning strategies. They're going to approach things completely different. So we've got to get to know who they are. We've got to get personal with them. And then from there, we can hopefully put a plan together that works for them.
And I really appreciate that. And I want to remind all those that are here with us live and those on replay, again, we're here to answer your questions, to help you get closer to retirement, and then not only get to the door, but get through retirement. And that's the one thing we're here for, is to make sure that you really understand and get the education you need.
Absolutely, because without education, what do we have? I mean, that's what empowers us to do the things we do in our life. The more we can learn about it, the more we can take action, the more we can help other people. It's all the key to life.
All right, Dave, let's get my next question on the screen here. So we're talking about Emma, who's 53, wants to protect herself and her husband, who's 61, in case of a long-term care event. Should she do this with life insurance or get long-term care insurance for this?
Let me talk a little bit about the life insurance side of it, because some on this Facebook Live event may not be familiar with how that works. So there are policies out there, permanent life insurance policies, that have a free, no charge chronic illness rider that you would be able to use the death benefit in advance for your retirement. For most people, if you look at Emma and her husband, 53, 61, they're still at an age that, assuming they don't have major health issues, they would qualify for a life insurance. And I would look there first, because when we look at it, what we find is it works better long term than long term care insurance does, because many long term care insurance policies, the premiums are going to keep going up. You're also going to have a situation where if you die peacefully in your sleep with some of these, you're not going to get anything back. So personally, I'd look at the life insurance, see if that's an option. If not, hey, then into long-term care, try to get a short pay. Now, they may not be in a situation like some people I've worked with in the past where they do it lump sum one time. Here's $100,000. I'm going to solve the problem indefinitely, but we definitely don't want that to go beyond really 10 years. 10 years about as long as we want that payment term to happen.
All right, Dave, I have car insurance. I have home insurance. I have insurance for my family. Do I really need life insurance?
In my opinion, yes, if you want to maximize your retirement. Now, what we talk about with these products isn't to give death benefit. Now, it works very well if you want to do that. I've got a couple of policies myself. Hey, my kids are going to inherit those. I know that's an X amount they're going to get because the way they were structured when I bought them, I'm not going to do anything else with that. But there's so many benefits, from a long-term care coverage to tax-free income that can come out of here, to removing market risk and sequence return risk, even inflation risk. I mean, all these things that insurance policies allow, that with the right structure and as part of a plan, and not the plan, as part of the plan, these things can work very well.
So what's the percentage? I mean, I know that you talked about in the past, my percentage if I get into an accident, or what's my percentage of a long-term care event?
Way higher than anyone would ever think. 35% of us are going to have a long-term care event. Now, where does that come from? Well, it comes from, once you reach average life expectancy, 70% chance you're going to have a long-term care event. Well, half of us obviously die before that. That's why we have average life expectancy, because half of us are gone, other half's left. So we take that, divide it by 2, 35%. That is the biggest thing we see out there from an insurance side that we've all got to deal with, yet most people aren't insuring themselves for it.
Dave, let's jump down to my next one. And again, I want to invite those that are here live, if they do have a retirement question, go ahead and throw it in, and we'll do our best to get those answered in our little 30-minute block that we have here. We'd love to be able to dissect that and talk to you and get the follow-up questions if you need any. In the meantime, Dave, I do have Eugenia, that's 66, recently lost her husband. Could she begin claiming his Social Security now and then take hers later? Would this impact her own benefits come time?
She can do this. Now, when we're alive and we're taking any type of benefits off of a spouse, we have what's called deemed filing. So again, once you start, you're basically stuck with the higher of the two, whatever the case may be. But one of the things that happens when someone passes away, and we're talking survivor benefits, you have the opportunity to start with one and then switch to the other. Now, you've got to assume that she hadn't started her own. Now, if she'd already started her own, her only option would be, hey, I can switch to his if his were higher at some point. But it looks like here she's not started her benefits. She could start on his benefits, get those, let hers grow to age 70. That point, assuming they're going to be higher than what she was going to get off his survivor benefit. And now she switches over and gets that higher benefit throughout the rest of her lifetime.
And Dave, as we talk about this too, I mean, a lot of times we look into Social Security and we think, hey, we want to get it as soon as possible. But what you're saying is let's not look at it that way, but let's see how much we can really get out of this if we follow what your advice is.
We've got to be more patient. Yeah, we get to that point, and all of a sudden the government's saying, hey, there's something free for us, I guess. I don't know, what the term would be, but really we almost look at it as free. It's like, hey, I can finally get this money that I paid into my whole life, and I can finally get access to it. I want it. Well, that's not really the right answer for many people. We've got to be patient with that. We've got to be willing to work. And even from just a self-respect, self-esteem side, we find it there. Many people quit work too early. I've got a sister right now. She's just getting divorced, unfortunately. She's 65 years old. She'd already started taking her Social Security. She thought she was done. Well, now she's saying, I feel worthless. I don't have anybody to spend my life with. I have nothing to do. And part of it was she was taking care of her husband, who had some medical issues. It's like, I just feel worthless. I need to go back to work. I've got to go do something. And for her, she's young enough, she can, and hopefully that'll happen for her. But unfortunately, sometimes it's too late. We miss that window. We get later on in our lives, and we just missed a window there.
Yeah, I really appreciate that. Dave, let's jump down to Dorothy and Thomas. So Dorothy is 68, Thomas is 65, and are looking at using a reverse mortgage to help make their home wheelchair and disabled accessible. They want to know if they must take the full home amount or partial.
Yeah, so let's talk about this a little bit when we're talking about reverse mortgages. And this is happens many times that this is maybe a perfect example of where someone is going to use a reverse mortgage to help them out because they don't have the money to make these improvements. But we've got an amount that the government allows us to use for the calculation, a home value, saying, okay, whatever that is, I think it's 970 is the maximum this year. So let's say they have a home that's worth $500,000. That's the maximum amount they can use to figure out their borrowing limit, how much they're going to take. Well, then that's going to get reduced based upon age and interest rates and everything else, how much they really have access to. Well, in this situation, they could do a credit line. Something many people don't realize is that they could use a credit line to be able to take just a portion of that, be able to pay for what they need to, and then have that credit line available if there's other additional things that they need, or if they never need it. Hey, it's just going to sit there and continue to, with those, they actually grow each year. If you got a credit line you're not using, the amount that you have for the next year actually increases each year.
Dave, with the market where it is that credit line great to take it earlier now compared to maybe in a couple of years?
Yeah, the issue, yes. I mean, from the borrowing standpoint of what they would open the door to that you would get is going to be better because the lower the interest rates are, obviously, the more that they allow you to get access to. They look at it expected interest rate. So it's not what current rate is. They use this expected interest rate. They can look at next 10 or 15 years and say, hey, what's that going to be? And then that's what they use to borrow to you. But obviously the rates go up faster than they expected. You're going to get less access to money later on than you would now. If you get locked in, then, hey, I'm in a better position because not only did I get it locked in at that point, but as it grows, I get the increased growth that happens. And the higher the interest rate is, which most of these are adjustable rate, the higher it is, the more that's going to grow if I don't use it.
And Dave, let's just talk in general. Is a reverse mortgage for everybody?
Absolutely not. I don't know what the exact number is. I use oftentimes 10 to 20% of America. I'm not sure if it even gets up as high as 20, but there is a percentage out there that it's great for. Again, going to work very well. We've got too many retirees that have got a home. Like I've got a good friend that lives in Puerto Rico. Now her home's not worth hundreds of thousands of dollars, but she's in a situation, she ain't making it. She's in a position that she's got her home value, she's got her Social Security, and it's just not enough every month. Well, she has no kids, she has no spouse, she has nobody to give her assets to. Hey, take a reverse mortgage, use that to help her have a better lifestyle every month. And when she passes away, you know what? There's no home value. It just is what it is.
And Dave, I appreciate that because we've been on several webinars, and you, in fact, have a webinar on reverse mortgage where you talk about this topic. And I think that that's the best part about this is we're making sure that you're learning about this, you're becoming educated, and instead of just saying, hey, when I get there, we're just going to look at a reverse mortgage to solve our problem.
Well, the best thing about what we teach, CR, is the ability to make a choice. We're not the guys out there hard selling people on anything we do to say, hey, you got to do this. You got to get a reverse mortgage. You got to put life insurance in your plan. You've got to do this with your Social Security. Our job is to educate people so they have the knowledge to make that choice. Hey, you got the information now on a reverse mortgage. If that works for you and you've done your homework, you've gone through your counseling session, please do it. You look at insurance policy. If it's something that you can see can work for you as it does for many other people, please do it. But it's that freedom of choice. Our job is to help people get that freedom of choice.
And I love that, Dave. And let's jump down. I've got a couple of questions here left. We've got Xander. So at 72, Xander wants to retire and move to a retirement community. He would like to give his home to his niece and nephew-in-law. Should he sell to them? What would that impact his retirement asset and taxes?
Yeah. So one of the things that he's got to be very careful with here now, he's got some gifting issues based on the value of this. That I think now it's $16,000 per year that could be gifted over to someone, and I've got to assume that house is worth way more than that. But a bigger issue may be the health issues he's looking at. He's 72 years old. He's going into probably a standard retirement community, but there's a 5-year look back period for Medicaid if he ended up in a nursing home, which could potentially happen. Well, the last thing you want to do is think you're doing a great thing for your kids, give them this, their niece and nephew-in-law, give them this asset that's worth hundreds of thousands of dollars. 3 years later, you're thinking, well, I got enough Social Security, it's going to get me through. You end up in a nursing home, it doesn't cover it, and you're waiting for Medicare to step in. They're saying, wait, you know what? We were going to cover $5,000 a month. That's what the difference was, but you just gave an asset away that was worth $500,000. We're going to divide that $5,000 into there. And whatever that is, we've got 100 months. We're not covering a dime for you until that's over. You're stuck. And now he's in a really bad situation. So as we get into those retirement years, got to be very careful depending on assets that are available if you're expecting Medicaid to help you if you end up with a long-term care event.
Dave, if we're looking at any type of insurance while we're in retirement, is it really that expensive?
It can be. I mean, as we look at the older we get, especially if we're looking at life insurance, the older we get, it's going to become more and more expensive. But it's not where people think it is. They think, hey, I get into my 60s and it's over. I'm done. There's no way. Well, again, life expectancy, 10% of you are going to live past age 100. Well, if the insurance companies run these blood tests to rank you as a one, two, or a three, hey, you know what? You can get reasonably priced insurance. But yeah, if you're a 51-year-old like me that had a kidney transplant, my insurance would be through the roof. If I want $1 million of coverage, it'd probably cost me 800,000 to get that coverage right now because they're saying, hey, not a chance this guy's going to live a long time with the health issues he's had.
I definitely appreciate that one, Dave. Let's jump over to our live one. We've got Gary on from Facebook. Gary's one of our good friends. We see him here all the time. We're so grateful that you're here with us, Gary.
Yeah, Gary, it's I think you're with us this morning for a couple hours. Good to see you again. Always fun to spend time with you.
All right, Dave. So Gary's wondering, what are your thoughts about my millennial daughter, Melissa's solo Roth K purchasing variable annuities?
So I'm not necessarily against this. I think one of the things we need to remember with these Roth 401ks or solo 401ks, if you got a 401k, my understanding is you've got issues with required minimum distribution. So a lot of times when we're looking at these annuities, we're saying, look, we may want to delay that. We may not want to take the money out immediately, or in an IRA, you don't have that requirement. A Roth IRA is going to allow you to put money in there. You don't have required minimum distributions you have to worry about. But my understanding, I know for regular Roth 401ks, it's the case. Not 100% certain on a solo, but I've got to assume so. So maybe a little concerned with it. Not saying it can't happen, but I would definitely look closer at, hey, can I get that money into an IRA and do it there so I never have to worry about those RMD rules?
Great. Thank you very much. And Gary, if you have a follow-up, let us know. Gary's coming to us, Dave, from San Francisco, way out there early morning.
I know, and I just can't wait to get out and see him. Gary, we're going to be at Engage in Vegas in June. I don't know how much you travel. We'll be there for a week for the Engage event with AICPA with a booth. Love to see you there. I know we keep saying we're going to try to get up to San Francisco. Just so hard for us coming from the other side of the country, but just know first part of June, that's where we will be for a week.
All right. Well, Dave, let's jump down. So Penelope got her certifications to do clients' retirement portfolios. What type of an annuity should she recommend to her clients as the best?
Unfortunately, there's no the best. I mean, when we look at it, because it's all based upon individual need. One annuity is going to work different for one person than it is another. You look at them, you got the variable, you got the fixed. Now, again, variable, Gary has a situation, they say, maybe right now she's young enough. I want to take advantage of the variable market, allowed to grow, allowed to fall, do all the things that it does. Well, you look at Gary himself that's saying, hey, I'm at a retirement age. Maybe that variable annuity is not working so well for me. We look at it, they have asset growth annuities and they have income annuities. Well, some people are saying, hey, I just want the assets to grow. I don't need the money, but I want that principal protection. Other side saying, hey, I got to have the money. I want that to match up with my Social Security. So I wish I could say there's a best. There's not. The best is what is it that's going to work best for you? And that's going to require some additional questions and some planning.
And I think that's what I was going to say, Dave, is I think if we look at what the best is, because the best retirement for you is going to look different for the best retirement for me. And I think that's the one thing we need to illustrate here is that we're looking for the best option for us, because I think that's really what helps us to decide. And again, somebody may be a little bit more aggressive than the other, and some of us may be looking at the market and then the volatility there. And what you're saying is we need to be able to have that opportunity to sit down and work with somebody.
Well, and it changes. You look at someone like myself. I mean, I had 6 children. Now we're in the process. So any day now, we'll have our 7th adopted. She's been in our home for months now, but she's special needs. Well, that completely changes everything. In fact, we're talking to our kids saying, look, she's getting the money. The reality of it is she's going to have to be taken care of. My other kids, generally fine with that. I've got my youngest. He's got some autism issues. So, Dad, I'm okay with that, but I want something. Can I just get something? Maybe
Mhm.
your truck? Can I get a couch, a rug, just anything from you guys? Which my wife and I laughed and said, absolutely, you can have all three. We'll give you the truck. You put the couch and the rug in the back. That's going to be your new home. But again, that changed substantially from where we were before. You know, you got now a daughter that's going to need going into her 30s, 40s, 50s, however long she ends up living. Versus a situation where you had six kids that'd be out on their own, educated, be able to produce income for themselves. So it changes, life changes. Your family's going to be different than mine. You've got two kids now, I know, that are college age, out of the house doing their thing. I've got three kids at home still that I've got to plan for. So.
Yeah, and I think again, that's what makes us so unique is that everybody needs to come on here and know that we're not just trying to make our retirement your retirement. We're coming on here to let you know that you need to understand all the aspects of this so you can make the best decision with your advisor that you're working with to make sure that you have the right retirement. And then you can get through it. It's not just, hey, I'll do this for a few years and see how it goes. You really need to make sure you're planning for the future.
Yeah, and those of you that watch our webinars, you know, I'm not having a milk cow in my retirement, but you know what? I might have a llama. I might have an alpaca. You know, those things may be part of my retirement, maybe a mini goat, but I'm definitely not having a milk cow. Well, somebody else living on a dairy saying, hey, we got 5,000 milk cows and we're keeping all of them because they're income producers for us.
Yeah, exactly. Well, Dave, let's pull up. So Ken Barton is a CPA, took his first retirement client, and they have a very traditional old school retirement setup. Where should he begin with helping them?
One of the things that I would definitely recommend is he's got to make sure he's risk basing this plan, saying, and there's software out there that does it. Now, unfortunately, a lot of the traditional retirement software people are using are not going to address the various risks, but it's really saying, okay, where are you now? And that's what I love about the advisors that we've certified and work with. It's like, where are you now? Let's put all of that in. Let's see what happens. Then let's stress this thing. Let's see what happens. And then let's put our strategies in and see what happens. We've got to see where that's going to go with these stresses, because I see it all the time, CR. It's really sad for me. I had a lady not too long ago break down in tears on me. She's like, wait, I went to my other advisor. We were perfect. We weren't going to have to worry about anything. Well, he hadn't addressed any of these risks. It said, hey, you're going to get an 8 or 9% return the rest of your retirement. Take $6,000 a month out, whatever the case may be, and you're going to be fine. Well, they didn't take into consideration what if the market drops and we lose all that? What happens if inflation stays where it is? What happens if we don't choose our Social Security at the right time? And so she saw that, she broke down in tears, just saying, I can't believe I'm here. Well, unfortunately, that's what we're here to do, and not to make people cry, but to help people really see that, hey, let's stress it. Now, hopefully it all works out without any problems. And if it does, great. You know what? You're going to have money left over. You may have extra money to spend later on in your retirement. But if it doesn't, I don't want you being in your 80s and all of a sudden going, I got Social Security, got to sell my house, got to move in. You know, if I'm in a facility, I got to move into one that's less than what I expected because all that money's gone.
Dave, one of the things I like about this, or I didn't like that I wanted to talk about, is the old school retirement setup, because I feel like if we look at any products out there, people are looking at the old school setup and they're afraid to take any action because they've heard about this. How do we help them to understand the difference?
Yeah, it takes education. I mean, that's really where it comes down to. And I've seen it for decades. Again, many times, financial advisors in general, a lot of them are obviously looking out not only for your interest, but their interest. How do we get the money that we need to be able to take care of ourselves? And they have various products or strategies that they need that to happen to make that work. Well, again, if we're looking at it and saying, hey, if I just do the basics, I do the traditional model and say, hey, if you get X% return and inflation's X and you get this much money available and you need Y to pull out at the end, well, then it allows them to get access to money that can be invested in whatever it is that they've got available. Well, again, we've got to look at it at a more overall standpoint. We got to talk about Social Security. We got to talk about Medicare. I mean, these are things we're not making any money off of, not helping us at all. Long-term care, maybe that's something that's not benefiting us, but they've got to be willing to look at the overall picture and say, hey, you know what? I am a fiduciary and I need to act like one. I've got to give them the best options of what's out there and stop worrying about my limited knowledge and what I can do to take care of myself.
And I love that you say that because, being a fiduciary, I love that you say we just need to make sure we're there. We're really trying to step up for that. I really appreciate that one, Dave. Let me get to my last one here. This was from Michelle. What is the biggest expense in retirement? We're talking mortgage, medical, insurance, taxes. Again, a lot of these are so blanket statements of what it is, but how do we help direct people on this?
My first question is, where do you spend your money? Unfortunately, it really comes down to individual. Now, I'm sure there's some statistics out there, and medical is becoming a huge one. That is becoming a big issue. In fact, they're projecting, some top economists are saying the average Social Security recipient will be spending their full $1,500 on medical costs at some point in the future. I hope that's not the case, but it is going to be different for everyone. I mean, if you take most retirees, hopefully they're out of debt by the time they get there. It's not happening. Can't tell you how many people I'm seeing going into retirement with their kids or grandkids' student loan debt. Maybe even their own student loan debt. I've had a few that it's like, yeah, we've been carrying this sucker for 40 years. And I'm like, what in the world? How can you still be paying on this thing? We've got to get out of that environment. We've got to get ourselves to where hopefully we're going in without the debt. And then it's probably going to become your medical costs. When you look at it from that point, taxes will be a big one if you don't have your plan structured correctly. I mean, I'm going to tell you that could easily be 20, 30% of your budget. So between that and medical, you're going to see a lot of your money disappear.
And so, Dave, if we're looking at this, I'm Michelle. What's the first thing I'm going to look at to make sure? Because, like you said, what am I spending on, first of all? But then on top of that, how do I even know where to begin?
Yeah, we've got to get our initial budgets figured out. And this is one area I love what Dave Ramsey does, Susie Orman, some of these other people in general. Again, from just helping from a budget standpoint. Hey, we don't need everything that we think we need. We don't have to have a beach home. Let's go rent a beach home once or twice a year, and going to cost us way less than all the money we spend to maintain that thing. Maybe we don't need a new, that brand new car. Let's go rent a car once in a while when we go on trips, and we'll drive it for a little bit, and that's going to work fine for us, whatever that case may be. But we've got to get that adjusted and then get the money available to say, hey, we've got to have something there. This isn't going to happen overnight, and spending is not going to get you there. And then we've got to put that plan in place to get them to where they need to be, so they have the assets and the structure. So as these risks happen, they can navigate around them and get them in a position they need to be in.
So Dave, you're saying that I want to go to the lake twice a year. You're saying don't buy a boat so I could do that.
Please don't. I know people do it all the time. I know you like the freedom. Those that do that can, go out and it's your boat. You can tell everybody at church or the country club how wonderful it is to have your own boat. But from an economic standpoint, way cheaper to just go rent that thing twice a year.
And Dave, so before we go, I do want to let everyone know, because we do have so many webinars coming up. And I think that's the one thing as we continue to talk about webinars. And I wanted to get our one that pops up on the screen here. It didn't quite fill the screen here, but I want to remind people about the Changing World of Retirement webinar that we have coming up tomorrow. And Dave, I just want you to talk about this class, because this is such an important webinar that we talk about.
Yeah, I love this class, not only because I teach it with multiple advisors, and tomorrow's with one of my good friends, Brian Britt, great educator, great opportunity to understand the concepts that we teach, but it's an opportunity for you to take a deep dive on the things we cover. I mean, in 4 hours, we're really giving you everything I teach, and anybody that knows me knows this. Hey, I'm giving you, an hour of content in 45 minutes, and there we give you 6 hours content in 4 hours. So we do move quickly. We do give a lot of information, but it's really where you can start putting the pieces together. You can start connecting everything and getting the chess pieces where they need to be, so that hopefully you can have success. And I'd love that class for it.
And Dave, we have others. I'll pop it up on the screen here. We've got the Foundation for a Secure Retirement, which is another 4-hour course that you break down Social Security, Medicare, long-term care, and elder abuse. A very, very important masterclass to be part of. And Dave, another one you have too is the Evolving Retirement Law. And I think this is another one that we need to make sure people are aware of.
Yeah, that's become one of my favorites. I mean, it's hard to say that because I love our master classes. I love our flagship presentation. I love most of what I teach on. But it is interesting because it breaks down why we're where we are. It talks about, again, the challenges, the changes, and our choices. But we went from an employer-funded retirement in the 70s to an employee-funded here in 2022. We haven't done a good job. I mean, it's been 50 years and we've done a horrible job, but I talk about what's happened there, talk about proposed changes, what the government's trying to do to help us, and then some choices that you can make. So I do love that class. I do have some good news for Gary too. He's asked for probably a year now, and we keep saying, hopefully next month, hopefully next month. we are getting a Roth class. CR is hopefully going to have the final edits done this week, and then I can get it launched through the various platforms next week, and we can get that out there. So we're finally there, Gary. I know you've waited probably a year at least for that class, and hopefully it's still value to you. I know it'll be valuable to other people because there is a lot of great information there in regards to conversions, contributions, backdoor Roths, how all these things work.
Dave, that's the one slide I should have got the front image on there so I could have loaded that to surprise Gary with. So maybe next week I'm going to have to bring that for you, Gary, so you can see that, and then we'll have some dates for you as well. I think next week we'll be able to pin down those dates of what we're looking for.
Yeah, we might just have to use him as our model for that class. We've got various slides where we've got various individuals that are in retirement or approaching retirement. So maybe that's what we're going to have to do.
Yeah, Gary, send me your photo and I'll see if I can get it on our front slide, and I'll change that picture. Well, I just want to thank everyone that's here with us live and those on replay. Thank you so much, because again, we're trying to help educate you, help you to get closer and closer to retirement, and making sure you're making the best decisions as you're getting there. So that way you don't have to worry about it and stress. So you're eliminating and possibly reducing all of these risks that are happening if you take action today. But that's the one thing, Dave, as we talk about 2022, I know this is a big year for you to talk about action.
It absolutely is. If there's anything that I want you to do is to take action. We talk about it in every webinar now. We've got slides on it through every presentation. Knowledge becomes power when it leads to action. And that's what we're trying to get you to do. We educate so many people, and we see so many of them take action, but we see so many of them just continue to stay where they're at. They think it's too hard. They think they can't get there. So why should I even put forth any effort? What we find is a lot can be done. Even if you're in your 50s or 60s, when we look at our lives over a decade, a lot can happen. But yeah, if we're looking at it and saying, hey, I can't get everything done in the next 6 months, you probably can't. But you can over the next 4 years, maybe the next 5 years. But it's only going to happen if you take action.
I love that. Well, Dave, thank you again for being here with us today. And we will see all of you and you, Dave, again next Wednesday, 11 a.m. Central Time. And we hope we'll see you soon.
Yeah, and I don't think we have a webinar to start with. So hopefully it'll be a little more low key when we get in here.
Yeah, let's see if we can just make it a smoother Wednesday. We'll see how it goes. Thanks, everyone.